Hey guys, KYT here. Really happy to be doing another video. The YouTube channel is gaining some momentum. I'm at roughly 300 subscribers, well on our way to 1,000 subs. So again, thank you for that. If you notice, my hair is super long. We've just had Chinese New Year and it's just bad voodoo if you decide to cut your hair shortly after Chinese New Year. So I'm going to respect my elders. I've told them that I've agreed to not cut my hair, so you'll have to deal with it. And I think people enjoy quick portfolio updates, so here we go. 100% XEQT. This is what we're doing, how we're doing so far on our road to $1 million. I'm actually really excited about this particular episode because I'm going to be talking about the efficient market hypothesis, EMH for short. And the reason I'm excited about it is because it forms the crux of how I invest in the stock market. It's why I invest in low-cost ETF. That's why I think they're the best vehicle for most people to hold their money in, and let's get to it. Now, EMH is largely tied to a man named Eugene Fama, an American economist who ended up winning a Nobel Prize actually, and it's largely because of a lot of the work he's done over the years, but mainly they say it's because of his article in the Journal of Finance in 1970 called Efficient Capital Markets, a review of theory and empirical work that spawned people to start taking it more seriously. Now, what is EMH exactly? Well, it's pretty simple. The EMH is a hypothesis in financial economics that states that asset prices reflect all available information. Now, before I continue the rest of the video, I do want to make sure I mention that EMH is not accepted by everyone who invests. There are people that don't think it makes any sense, so do your own research and figure out if you agree with it. I, on the other hand, after doing a lot of research, believe that EMH is a very, very useful tool. Now, what does EMH imply? It implies that at any given moment in time, there's no security stocks that are either overvalued or undervalued. Now, how's this possible? Well, it's possible because there's active participants in the stock market. So if the price of a given stock is low, but a large group of the experts in the market with a huge amount of funds believe that that price is undervalued, they're going to bid or buy a lot of shares of that company, hence driving the price to some sort of equilibrium. So what's an example of new information that could affect the stock price? Earnings report. The first one that comes to mind is Netflix, when they showed that their numbers were underwhelming for what people expected. Like Q1, they expected a much higher subscriber count than they projected in their last report, and the market reacted. The market reacted very negatively. It dropped roughly 20%. And us as the average investor, we can treat the market as basically fairly efficient because by the time that we, the average investor, have the time to register this news, figure out if that's good or bad for the stock, by the time we go to buy it, the stock should have already reacted. So, and it has, as you can see in the graph. Now, I do want to address a lot of counterpoints that are commonly thrown around when this happens. If you've been around with GameStop, you'll have people writing blogs titled "How the GameStop Fiasco Invalidates Efficient Market Theory." You'll have a bunch of people on Twitter suggesting that these 20% plus drops are evidence. They're just clues or evidence or proof even that EMH is not a good theory. And then there are people that, I guess because they stock pick, so they have to really want to bash EMH. Like this tweet that says EMH states everyone in the market is a rational actor with full access to all the info and making sound, well-balanced and thought-out decisions. And to me, that's not what EMH is about, man. Large jump in prices or large cratering of prices do not invalidate EMH. EMH only says the reason it's so hard to prove or disprove is because it's a really simple concept. All it's saying is that the market will react to news really fast. Whether that news will affect the price to jump really high or really low, it doesn't matter. That's not what EMH is trying to say. I think people are really attached to this idea that EMH means that the price is right at all times. It doesn't mean that. But even if it did, that doesn't mean it can't react substantially to some really crazy unexpected news or even expected news it's within the range of expected outcomes, but it's a really bad or really good news. Like if the CEO of a company dies and it's a really important founder, for some companies, I could see it having a pronounced effect on the stock price. So again, having it shift one way or another in a big way does not really mean anything with respects to EMH. And the fact that it responds fast before you yourself can go or buy or sell the stock is an indication that the stock market is fairly efficient. Another example, like just imagine if somehow the US said Bitcoin's amazing, you don't have to pay taxes on your Bitcoin ever. EMH, if the crypto market is efficient, that price would jump really high based on this news before you can even buy and take advantage of this news. That's what it means. So, but then some people might bring to me like GME, look, KYT, like the prices was way off its fundamentals. How can you believe in EMH? It's clearly inefficient. And to that I say, like, information, when it comes to information in the context of EMH, it does not mean that the information is necessarily just the basic fundamentals, like finance fundamentals, like PE ratio and all of that stuff. Like some information you might not consider as information. So just even the possibility that there's a short squeeze, the possibility that retail investors would be jumping on board with this movement. All of these things are information, and how the market participants view this information, how they value it into the price of the stock is up to them, and it doesn't really invalidate EMH. The only thing that EMH implies is that, let's say GME, at any given point of this graph, you wouldn't know whether to buy or sell. At that precise moment, you wouldn't know whether the run was over or the run was just beginning. You wouldn't be able to consistently do it, is what EMH implies. Now, does that mean I don't think the market is beatable? I actually think it is beatable in specific instances, but it requires some special things. It requires you to have information that the rest of the market does not already have, or it requires you to have information that you feel is grossly underrated or overlooked by the market. And of course, there's insider trading, and funny and not so funny story, I guess. I found out a few years ago that a colleague of mine from McGill University got caught for insider trading and had to foot a $1.2 million bill. As you can see here, the OSC alleged Mr. Zhao earned profits of $416,000 from buying shares of 5 companies after learning that they were involved in merger and acquisition deals in 2010 and 2011. Nesbitt Burns was working on all the deals, and Mr. Zhao admitted he learned about the transactions by accessing a shared network computer drive. Now you might ask, KYT, if you believe that no stocks are overvalued or undervalued, why even invest, right? If you think everything's like whatever, fairly priced, why invest? Why even bother? That's a good question. Well, the answer is that the stock market as a whole will go up over time, right? Not every year, but over time, you can count on it going up, which means on average, if you pick any random stock, the average stock is supposed to give you a positive return. The reason that you would want to capture the entirety of the market over picking specific stocks is because of the positive skew, which I might get into in a future video. Positive skewness of the stock market suggests, based on empirical data over the years, that most stocks either do okay or poorly, while a small percentage of stocks do really well. And those are the ones that are responsible for the performance of the index. So if you miss out on some of these stocks that overperform, your portfolio is going to underperform tremendously against the index. Now, there are a lot of implications. There are a lot of beliefs that are stacked on top if you think EMH is a useful tool, if you think the stock market is fairly efficient. There's a lot of things that come with it. And one of them reminds me of the inspiration for this video. Is a friend of mine who asked me if energy stocks are a good investment. And when I said I didn't know, I didn't mean to imply that they were a bad investment. And I think that might have been, my friend might have been misled into believing that. But what I was trying to say, and if you've watched the video up to this point, you wouldn't know my opinion, is that there is no overpriced or underpriced security at any point in time. And I don't really know if buying energy stocks now is a good or bad deal. Great stock returns rely on over exceeding market expectations. And it's not a commentary on whether the industry will explode or not. Like the energy sector might crush, but due to competition between other different companies, specific companies might not be profitable. And you can look at the cannabis industry. Everyone was hyped about it, but there's all these companies, there's all this competition, splitting the market share, which is why none of these, it was one of the biggest underperformers over the past couple of years. So while cannabis might be everywhere around us and it's a very visible industry, it does not mean that it made for a good stock investment. And another implication that I'm going to probably get a lot of response from all my friends that invest in individual stocks is that, of course, if you're an EMH guy, you do not believe in too much in buying the dip. That's not to say that some stocks won't rebound. It's just that you won't, again, the message is that you won't be consistently right. You might be investing in something that does rebound very fiercely, or you might end up investing in something like Baba, where you felt at multiple occasions you were buying the dip when unfortunately you were not. I'm going to end this video with one of the key points of all this is that the reason we think markets are probably fairly efficient is the fact that most active managers cannot beat the index or the market over a long period of time. If they can't beat the benchmark that is the market, that means that they cannot consistently find stocks that are overvalued and undervalued. I've said a lot here and some of it might not be clear, so I hope you guys interact with me in the comment section or tell me what point that you want me to elaborate on. And with that said, I'll see you in the next one.